So in this module, guys, we'll be talking about something that's very important, get a lot of questions on, and a lot of something that kind of really differentiate a lot of different things is interest rates, right? So what is a mortgage rate compared to an interest rate, right? So people get that quite a bit. So mortgage rates technically are interest rates. Mortgage rates usually are lower, right, than interest rates, and I'll explain why. So first, let's talk about what is an interest rate, right? So when, let's say, you go to a bank, you want to borrow money, they come back to you and say, listen, this is the interest rate on this loan, on this line of credit. What does that mean? So technically what it is, that is what the bank is making, let's say, their spread or their profit into lending you money, right? That's technically what that is. So if you're borrowing, let's say, a $10,000 line of credit, the interest rate's 8%, you get to use the benefit of using the bank's money, so let's say 10,000, and then you pay them back something in return for that convenience, right? Which is their spread. That's what they want based on the product that they've given you. So if you're paying 8% on a line of credit, they're making 8% on their return, which is something that they've given you to do, right? Now, mortgage rates, they're also interest rates, but they're usually lower, right? We don't really hear about mortgage rates being on 8%, right? Usually mortgage rates kind of hover around the 2 to 3%, maybe a little bit more. So why are mortgage rates lower than interest rates? And there's a really good reason for that, right? So one, mortgages are usually larger and they're usually based on security, right? So they're usually secured, either coming with land, a home, or a condo, whatever it is, but the security attached to that. So in that reason, right off the bat, there's low risk, right? So banks usually price rates based on risk. So if you're taking it unsecured, there's a higher risk to it. So they will give you a higher rate just to kind of account for that risk. With mortgages, a little bit more secured, has a lot more stricter rules, a lot of stricter guidelines to get approved. So based on that, rates are going to be a little bit lower than something what we call unsecured debt, like a credit card or a line of credit or a loan. In that scenario, so that's the reason why mortgage rates are a little bit different than, let's say, unsecured interest rates, right? Technically, they're both interest rates. One's going to be a little bit lower than the other. So how do banks kind of figure out what rates to charge? Now, when it comes down to interest rates, there are two ways to look at interest rates for mortgages, right? One is like a fixed rate, and the other one's a variable rate, right? So what's the difference between the two? So a variable rate is kind of based. It's a fluctuating rate. That's what's called variable, right? So it kind of varies. So it's based on the overnight rate by the Bank of Canada. So in that situation, this is the easiest way I can explain this, right? So like Bank of Canada has something that what they will do is that they'll lower or raise their rates based on how the economy is doing, right? So it kind of maybe to offset inflation. And you'll hear terms like the overnight rate today or the Bank of Canada rate today is 1%. So that automatically impacts prime rate, which the banks kind of charge, right? So bank prime is different than, let's say, the Bank of Canada's overnight rate. So today, prime rate is 3.95%, but the Bank of Canada's rate could be 1.25 or 1.5%. So once again, maybe they're borrowing it at 1.5, and they're lending it out at 3.95. And the difference is, once again, their spread. That is what the banks are earning on the money that they're lending out based on prime. But usually when it comes down to variable rates, you usually get prime minus, right? That's usually what it is. You get a prime with a discount on it, a little bit lower than prime, and then every bank will have different reasons to give different discounts just based on their own lending criterias. They might want to attract a lot of business, so maybe the discount is greater, maybe sometimes it's not as great, maybe sometimes the fix is greater. Every bank will have its own needs, right? Now, fixed rates are based on the bond market, right? So there's bonds that are trading. It could be a 2-year bond, 3-year bond, 4-year, all the way up to a 10-year bond. And bonds are just investments that banks like to sell to kind of raise capital, right? So a 10-year bond would be trading, let's say, at a certain amount. So the 10-year fixed rate will be based on that amount. Well, let's say a 5-year bond rate is trading at a certain amount. So the 5-year fixed rate is kind of based on that, right? So, but sometimes, let's say, if the banks are running out of a certain bond, and they need to raise capital for that bond, sometimes they'll try to make it more attractive to investors by giving a little bit of a lower rate. So they'll probably give a really good discount on a 2-year mortgage or a 3-year mortgage, depending on what they want to raise capital for. And sometimes you get a discount, right? So most of the time, going with the longest term possible usually ends up getting the lowest rate because banks like to reward that by saying this person is going to be loyal to us for a certain time period. If you're going for a 5 year, usually 5 years tend to be the lowest that you go because it's a sweet spot, right? So 5 year is what banks like. The client is going to be loyal with us for about 5 years. So you try to get the best rate. But sometimes you have a really big discount on a 2 year or a 3 year, depending on what the banks want to raise capital for those kind of terms. And sometimes they make it really, really attractive. So not always does it make sense to go with the 5 year, right? It could just make sense to see whatever the lowest rate is, to see what the difference is at that time, and then kind of go with that, and then decide if that makes more sense for you, if a variable makes more sense for you. A variable comes with a certain amount of risk, right? So you want to be associated with that risk, understand what that is. The rates could go higher, and that does affect you very directly, right? Because payments are based on interest rates. So if you want a variable and your interest rate goes up, there's a good chance your payment's going to go up as well, right? With a fixed, it's just fixed. Payments are not affected. Rates can be moving up and down all around you, but you're in a fixed term for a certain time period. You're going to be safe, or you're going to be in that time period for that period of time.